let me just confirm that everything is recording. All right. Yes, we are recording. So good evening, everybody. Thank you for your patience. I think there was an issue with the link that I provided, so that is my mistake. But nevertheless, thank you guys for taking the time to be here this evening or this afternoon, wherever you are in the world. Welcome to the Wealth Mindset and Real Estate Investing Meetup. My name is Chris Price. For those of you who I do not know, I am the host of the Wealth Mindset and Real Estate Investing Meetup, and I'm also the CEO and co-founder of Red Fox Multifamily. And so let me tell you a little bit about us before we get into tonight's event. So the Wealth Mindset and Real Estate Investing Meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, network to do it at speed and at scale. So this meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investment. And now Red Fox Multifamily works with investors who are dissatisfied with the low returns from savings accounts and bonds and investors who are concerned about the volatility of the stock market. Red Fox Multifamily puts discerning investors' capital to work for them by investing in exceptional multifamily properties in the best markets nationwide. Demand for multifamily rental units continue to grow and driven by both the preference of certain demographics and as well unfavorable single family home ownership options. Red Fox Multifamily.
We lost your audio, I think, Chris. I cannot hear you.
We're gonna go get her.
This I hear somebody else.
Okay.
I feel so weak when you stand up, but I think it's just.
Do you want to wait till tomorrow?
You're muted now.
I think
Okay.
someone had muted me saying
Oh,
thank
really?
you. Yeah, that's interesting. But you can hear me now?
Yep.
Great. So just finishing up, Red Fox Multifamily is based in White Plains, New York, and partners with investors for whom the stability of real estate investments appeals, but the stress of property ownership does not. We give our investors the benefit of real estate investment through syndication, which is group investment in multifamily property. So with that, let me transition over briefly to our logistics for this evening. So for those of you on the line, please mute your lines when you're not speaking. Please hold your questions to the end, or unless our speaker for this evening ask you to ask your questions along the way. I think typically what I've observed is that your questions get answered along the way. But of course, if there's something burning, please feel free to take yourself off of mute and ask your question. This presentation is being recorded, and please note that this material does not constitute an offer or solicitation to purchase securities. This is information only and should not be construed as business, financial, or legal advice. And just finally here, for those of you who want to learn more about this meetup and more about what we talk about here, please reach out to me. Interested in multifamily investing, please feel free to reach out to me. You can email me here or scan the QR code, and my information will be available to you. So in terms of our agenda tonight, let me get down to it. Tonight, we have an amazing speaker. I'm going to introduce him in just a moment. And then our speaker is going to present, and then we're going to have a brief Q&A and some virtual networking for those who want to hang around for a few minutes afterwards. So without further ado, let me go ahead and introduce tonight's guest speaker. So give me one moment. All right. So tonight we have Philippe Schulligen. Philippe is the co-founder of Boost Capital, a firm dedicated to help family providers who want to preserve and boost their capital through passive real estate investments. He has helped busy professionals and parents to invest passively in 15 properties totaling 2,800 units. In the roles of general partner and key principal, he has firsthand experience in commercial multifamily real estate, acquisitions, syndications, asset management, and dispositions. Philippe also shares his experience with entrepreneurs as a mentor and with passive investors and operators as an advisor. Prior to being full-time in real estate, Philippe worked a corporate job in the business and military aircraft industry in project and team management positions for over 20 years. He holds a master's degree in science and mechanical engineering. Um, Please join me in welcoming Philippe. And thank you again, Philippe, for this. And before I just pass it over to him to present, I just must say this, Philippe is also my mentor within a mentorship program called the Michael Blanc Dealmaker Mastermind and Coaching Program. And Philippe has been terrific in helping me along my journey and transitioning from being a passive real estate investor to an active real estate investor. And he has a wealth of knowledge, a wealth of experience, and I think you guys are going to really get a great learning a lesson today about multifamily business plan 101. So without further ado, let me pass it over to Philippe to educate us tonight. So Philippe, it's over to you.
Okay, thank you, Chris. Actually, I realized I don't know if you meant to share some slides on your end because I didn't see anything. So
Okay, I did have something shared, but I will reshare it at the end. So I think
okay,
something
no
happened
problem.
when I
So
stopped.
we'll just move on with my my thing here. So give me one sec. Can you see
Yes.
my screen? All right, very good. Yeah, so thank you, Chris, and thank you everybody for joining us tonight. My name is Philippe Schulligen, and co-founder of Boost Capital Group. I will not go over the bio that Chris gave already. So tonight, I wanted to talk about the Multifamily Business Plan 101. And I have about 25 slides. It should be hopefully, and sometimes I talk a little too much, but we should be done within 20, 25 minutes or so, and then we'll have time for Q&A after that. So let's dive in, right? So you found a deal. What are you going to do now, right? And the business plan is going to be a tool for you to articulate your vision of what you're going to do with that property that you're going to purchase, right? You're going to put together the different pieces to explain and present to investors this acquisition, and with the goal of raising capital, right? So that's why you're doing that business plan. And actually, once you have that document put together, and again, you can use that document to present to your investors, but the SEC lawyer is going to attach that document to the private placement memorandum when making that private placement memorandum like a whole package that not only describes the attributes of the deal that you're presenting or you're raising capital for, but also the business plan. So for whom are you going to write the business plan, right? And you can take 3 point of views. There's yourself, because you want a clear vision of why it's a good deal and how you're going to make money throughout the deal. It's a tool for lenders because, even though they're going to do their own due diligence, but there are a lot of questions that they're going to want to get answers about, such as, how are you going to invest? Are you going to do renovations? Are you going to invest in marketing? Are you going to add units in the property? And they will want to know who are the general partners, who is the team, and who is going to manage the day-to-day operations. And finally, and obviously, and I would say that's probably the most important factor there. It's for your investors. So it's going to be the tool that you use to give confidence to the investors to invest in the deal. So for an overview, there are really like four main points that you need to address in that business plan. First, you're going to talk about the market. Oh, sorry, I just saw a notification. Is the connection okay?
Yes, the connection's fine.
Okay. So I hear some background.
I just muted the person.
Thank you. All right. So four key topics to address in the business plan. First is going to be about the team, the market, the submarket, and the property itself. Another area to cover is explain exactly how you're going to increase the net operating income, which is equal to the income that you're going to collect from the rents and sometimes other income as well, and also all the expenses. And by increasing this net operating income, you're going to generate additional value for that deal. The third thing to talk about in a business plan is to talk about the deal structure from a financing and partnership standpoint. And finally, you're going to illustrate projected returns and or let's say a projected profit and loss, as well as returns for the investors. All right. More specifically, I put like all those 16 items we're going to go over here, but I'll just transition directly to all these items. So we have 16 items. The first one is you want to give like an executive summary, or a summary, like a one-pager. Why is this a good deal, right? In one page. And maybe you want to talk about the opportunity, like for instance, and by the way, all the illustrations here are from past or current deals that I have. So it's all deals that I've been involved in. And so we have an example on the left, pretty simple. You're talking about, what are the expectations, 10% cash on cash. Obviously, that was a deal some time ago. These days, it's much harder. And, you're going to double your investment in 5 years. And, why is this a good opportunity? It's a very strong location, great long-term financing on that particular deal. The other illustration on the right, it's a little bit of a different format there, because it's a portfolio. It's actually about an active deal that we have. I just put a little line about the projected equity multiple. And also, because it's a portfolio, what we wanted to highlight there is the attributes of the portfolio. So because we have 3 assets in 3 different markets and 3 different business plans, so it's very a unique proposition that we had in that case. Next, we have, and again, you know, so obviously the sequence there is up to you know, there's no no obligation to do things that particular order. So, you know, it's up to the sponsor to make that presentation. You know, how they think. But the second topic to be addressed in any case is why is the team assembled for that deal ideal, right? So you're going to want to talk about, give a short bio about the different team members, also talk about their track record, and you know, additionally, usually, and I think it's a good thing, is you want to put forward the property management company, you know, especially if they have like a lot of units under management, and you know, they are a big shop, because they're going to have a lot of experience, obviously, and that's something you want to put forward and share with your investors and lenders. Finally, you can also mention who the lender is, who is your real estate attorney, your syndication attorney, and your CPA. It's not necessary, but always good, you know, if you need to add, you know, additional credentials to show that you have a strong team behind the deal. So next topic is, you know, you're going to want to talk about the market. You know, why is this a good market, right? So you know, obviously you're going to say which market it is, but you know, you're going to talk about the population size and you know, if there's growth, and you know, ideally you want a pretty large you know, market, you know, such, you know, in the I like the 500,000 plus, you know, ideally 1 million people in the metropolitan statistical area, and you want to have that population that is growing as well, and you know, you can look at the statistics, but that's for the sponsor, but you can share the statistics in the presentation. Also, you can talk about employment trends, the key employers and industries, and any, you know, major news. You know, if there's like a company, I'm looking at a deal right now, and there's this electric cars company building a factory in that particular town. So it's a very appealing proposition to have an asset in that town, and so I showed you like two different examples. You know, something a little more older, I think, in terms of how we present things, and you know, less colorful about Birmingham, but you can see, like, you know, there's information about job growth, the population growth, and some other features such as affordability and low taxes. The other example is about the Atlanta market, and obviously being a large market, you know, there are a lot of information, you know, number 1, number 2, and all these statistics that you can share, as well as the key employers you can see on the right of that particular illustration on the bottom left here. Next, you want to talk about the submarket, and I apologize for the overlap there, but you know, why is this submarket attractive compared to the rest of the market? And again, so you know, it's kind of the same approach there. You know, you're going to talk about the key employers, key businesses and attractions, stores and whatnot. But more, you know, instead of looking at the big picture of the whole market, you're going to be looking at a more specific area. Also, depending, and particularly if you do Class A, Class B, you know, you want to take a look at schools, because good schools will attract quality tenants. And additionally, you can give information about the average household income, because you want to check that the and I mentioned average, it should be median, but you want to make sure that this particular market is going to support the rents, and you know, for a good filter for rents, for instance, is going to be that you have 3 times the yearly rent that is lower than the median household income. So you want people to be able to afford to pay the rent, right, and have obviously additional income to pay for other necessities. So another interesting information, and you know, you're going to want to start characterizing a little bit your tenants. You know, what you know, how many jobs in that sub-market. You know, is it like white collar jobs or blue collar jobs? Again, you know, if you're doing a class C property, which is more like for workforce housing, you're going to want to have a lot of blue collar jobs. Obviously, class B could be a mix. Class A typically is going to be white collar jobs. So next we have, you know, we're going to talk about the property itself, right? So what are the characteristics of that property? You know, so the class I just mentioned some examples, class A, B, C. The number of units, of course, the floor plan breakdown, how many, you know, 1 bedroom, 2 bedroom, etc. The unit size, the occupancy, you know, is this a stable deal or is this, you know, mostly vacant? And you know, like the financing terms will be different depending on what kind of occupancy you have and distress you have in the property. Typically, anything above 90% physical occupancy is considered stable, and then you have more options to finance your deal. Your build, you know, it's important to know about the your build. You know, older properties, there will be more maintenance or required, or you know, you need to make sure that there was sufficient capital spent by prior owners to fix the property. So you may end up with an older property, but if it was well maintained, you know, it's not necessarily a problem. You want to know about the amenities. You know, is there a pool? Is there a washer and dryer in every room? Is there a playground? You know, assigned parking, covered parking. I know in some of the hot states, they have some of those covered parking in Arizona, for instance, etc. Then what are the current rents? You know, where how is the property performing, right? And how you're going to compare that property to in terms of occupancy, rents, and sale price to other properties nearby. So again, some illustrations. You know, here we have an example. You know, obviously you want to promote best-in-class amenities, so that would be for a Class A property in that case, and you know, luxury interiors. That's on the top left there. Then you know, you have the example of the floor plans, the breakdown, and you know, maybe you can put a little picture or a drawing and a pie chart showing like the breakdown of the units. And finally, on the right, you have an example of rent comps, and you know, I like these bar charts because it's very easy to see how you compare the current rents to the market, and then you know, usually you could show, you say, okay, well, you know, we're going to be able to target like the mid range of that the rent comps, for instance. Next topic is the income improvement. You know, how are you going to increase your income? If you remember, I was talking about you want to increase your net operating income, so it means increasing your income and decreasing your expenses. So how do you plan to do that? Well, you know, and I just mentioned it. You know, you'll be able to, you know, with the right renovations, you'll be able to, or the right level of finishing, to bring the rents to comparable market level rents. right? So the otherwise, maybe you can do additional renovations and kind of bring the property a notch. And for instance, I see there are a lot of renovations these days. Depending, like let's say on a class B minus type of property, you're going to do like granite countertops in the kitchen, and it will bring the property up a notch, and you can achieve even higher rents doing those things. And that's true for interior renovations. That's true for exterior renovations. Also, you're going to what are you going to do to raise the occupancy to the market level? So if the market, everybody's at 95%, there are chances you can achieve that. So there are some steps you're going to take, maybe more marketing. For instance, and I believe I talk a little more about the occupancy later on. Other ideas which are more on the other income level, you have all these, if you do a bulk cable contract, a cable internet contract, then the provider will give you a cut of how many units multiplied by the plan that you're going to ask them to take. That's something you can impose on your tenants as well. You have to take this cable contract, and that's part of anybody has to take it on the property. Pet fees, garbage pickup, preferred parking, and laundry rooms, storage units, vending machines. Those are just some examples of how you can increase income. Again,
Hey,
some
Philippe,
examples.
This is Chris. Just a quick thing on the bulk cable and internet contract. I actually had a chance to tour a property in the Dallas area that where the sponsors actually were implementing this, and it's great for the residents, right? Because they get to have the way that it's set up is that they provide internet everywhere on the site. So no matter where they are, that like if they're at the pool, they can have Wi-Fi, or if they're at some other place on the property, they always have the internet connection. I thought that was a really nice amenity to have. But I just wanted to add that comment.
That's right. Yeah. Especially these days. Yeah. That would be part of, and that's something you can negotiate with the provider. Absolutely. So going back to the examples, I think what's interesting, even though not very, I think the presentation is a little outdated, but I think it's a good statement on the top there. Like the renovations will increase the desirability of the property, right? So if there are more people interested in moving in, then you can bring the rents a little higher. And moving to the next illustration at the bottom. So here you can show like all these. So obviously it's a pretty large property there, but there will be private yards that will be set up, storage units, garages, valet trash, internet we just discussed, amenity fee. Which I'm not even sure. I don't remember exactly what it is, but sometimes you have some of these interesting fees adding up, and water and sewer fee that can be collected. And see here in that particular deal, we are generating by implementing all these additional income topics, we're generating an additional $217,000 per year, and that would translate to $5.2 million actually on that particular deal of value. Next, renovations, right? So kind of on the same page or along the same lines of increasing income. you know, you have to talk about the renovations. What's your renovation plan? And you know, what did you find when you inspected the property? You know, in terms of renovations that you have to do. Maybe there's some capex, maybe there's some roofs to change. So those are things you want to talk about in that chapter. You know, and give like a specific list of interior and exterior um, things that you want to upgrade and how they compare to the submarket. Who is going to do this work? You know, are you going to use the property management company or use a third party to speed up maybe the renovations? You know, talking about speeding up, you want to share about the schedule of these renovations. We will, you know, renovate X amount of units per year, and we'll do the renovations over, you know, is it 1 year, is it 2 years or 3 years? You want to share also the budget for the total capital expenses and the target rents after renovations. So an illustration here, you know, like for, and I think it's certainly recommended to make that presentation as visual as possible. So you can do like some pictures before and after. Always nice to see, have an idea of what the sponsor has in mind in terms of renovation there. Expenses improvement, right? So how are you going to decrease expenses? So well, the first thing, so you know, is there an opportunity because, you know, maybe it's self-managed, right? And it's not managed by a professional third-party property manager. So maybe like the cost of running things is not as optimized. So that's always a potential area to save on expenses. I added the rubs there, but I guess, you know, technically it's a mistake, should be in the income. But the rubs is really like a way to make the tenants pay for a part of the utilities when the utilities are paid by the owner, and that's as I said, it should be in the income category. Now, if the owner is paying for water and sewer, for instance, you want to implement a water consumption reduction plan with low flow faucets and you know, other, same thing for the toilets and showers. You know, additionally, that's interesting. You know, any type of green initiative can give you access to also additional type of lending. I know there was a funny green type of loan at some point, and there are other. Actually, yesterday I heard about was a C something, but other lending grants that you could get possibly. Finally, another thing, and that happened on my second deal, we had a state tax incentive. And actually, so you know, I have like the whole description here. I'm not going to go over it, but sometimes if you invest, you can get a tax incentive. And again, you know, you reduce expenses, you increase the value of the property. Typically, these tax benefits they will last for quite a bit of time, and you know, in that particular case, it's for 10 years in the example I'm showing, and you know, it's a great way to save money. So going a little bit deeper on the examples that I'm showing in terms of illustration in the business plan. You know, we are going to reduce water and sewer. You know, I mentioned that earlier. Reduce payroll, right? Because for some reason the owner, you know, maybe sometimes it's the case, you know, that they're just adding some extra expenses on the property, but doesn't mean that's how it operates really. And The other example is about the tax benefit that I mentioned as well. Attract and retain tenants, right? You know, if there was a problem, maybe in occupancy, you want to talk about, you know, your plan, you know, your marketing. You are going to do, you know, which steps regarding marketing. You know, are you going to advertise maybe on apartments.com, for instance, very popular. A lot of leads usually coming from there. Are you going to you know, have a leasing and maintenance management improvement? You know, how are you going to take care of that? You know, maybe maintenance was not great during the prior ownership. Maybe the people taking care of leasing, showing units, they were not doing a good job. So that's why, you know, again, you come with professional property management, and you know, that will help you take care of issues of that level. Also tenant screening. You know, sometimes I see these deals that, you know, they're showing, you know, like 10% of the tenants with a balance in terms of what they owe on rents, and you know, that's certainly a sign that their tenant screening was not great. And again, that's something you can improve by bringing third-party professional property management. Also, you know, sometimes if it was an area with a little bit of higher crime, let's say, and obviously try to stay away from those areas if you can, but sometimes there are good deals. So, you know, you can install a gate, you can install, you know, a security system like cameras in that particular property. Also, another thing, you know, that is a good idea that I heard, you know, people doing that pretty successfully. You want to develop a sense of community, and you know, organize on a regular basis some events, and build, you know, it's like, and it doesn't have to be extremely expensive, but you still have, you need to have somebody take care of this. It could be a barbecue, it could be, you know, just doing some activities with the children at the playground. But those things, you know, if you can develop a sense of community, and then you have like tenants who are referring the apartment complex to their friends, so now you're going to attract more tenants. Next, switching gear here quite a bit, capital stack. So you're going to want to talk about, obviously, the purchase price, your loan type, amount, interest rate, term, and amortization, your down payment, any fees, and investor equity. You know, have an example here. We're talking about the sources and uses. You know, where are you going to get your money from, and how is it going to be deployed? You know, is it closing costs, capex, acquisition fee, contingency, and working capital? Here an example about a loan, bridge debt in that case, non-recourse, 3 years term, and interest only at 7.27 interest rate, which on that particular deal, it was kind of 50% occupied, a little bit distressed deal. Financial projections, right? So what is, you know, when you underwrote the property, how, you know, the numbers came up, and what are the how are you phasing out the target rents? You know, what are your assumptions about vacancy, and you know, what are the income and expenses? You know, how does it look after you pay debt? You know, what's the cash flow? So this is all, you know, I know it's a little small, but it's you know, just to give an illustration, and it's not something necessarily you're going to spend a lot of time on, but you know, there are some investors who are interested in looking at this level of details. The structure. how the profits are shared. What kind of fees. There could be acquisition, asset management, capital event. Some people can be very, very creative about fees. What are the split? How we're going to split the returns? It could be 80-20, 70-30. That's the case in the example below. And is there a preferred return? Yes or no? Some people do, some people don't. There are pros and cons. Could be spend a half hour about this to go a little bit deeper. But also, if is there any classes? There could be a class A, class B, with different returns, and maybe class A, they have like a fixed return, but they will be paid first, and then you have class B that is a more traditional split, etc. And then you have hurdles, which is, if we achieve our goal of, let's say, 15% internal rate of return, then the split is going to change from 70-30 to 50-50, for instance, between the investors and general partners. Exit strategy. So you want to talk about, how long you plan to hold the asset for. Is there any cash out refinance option that you're looking at, or is it your business plan to do a cash out refi? Which it's not necessarily something I'm very comfortable with, because it's hard to have visibility on interest rate down the road. It's like, how do you know? So unless you're very conservative on the interest rate with a refinance, so it's not necessarily it's hard to implement in my opinion. What is your cap rate at exit, and which the cap rate being the net operating income divided by the purchase price. And over the years, cap rates nationwide have trended down, but now that there's a flip and interest rates went up, cap rates are turning around. So what are you going to use at exit? Who knows? We can be in an environment, interest rates, they continue to go up for a while. So you want to maybe, to be conservative, add a few percentage points or decimals to your cap rate on a yearly basis. A good idea for that is 0.1% for as a starting point, at least.
Hey, Philippe, just a
Yep.
quick question. Someone had posted a question in the chat. If you could quickly just clarify around the different split breakdown. So you had the 70-30, you had waterfalls, hurdles. If you could just touch on that briefly, I think that would help clarify.
So yeah, so the split is I apologize if it wasn't clear. It's here in the example we're showing 70% for the limited partners, 30% for general partners. So and I'm just focused on that example for now. We'll talk about the pref return after. So it means that after all expenses are paid and the debt and any potential fees, the very bottom line is going to be the cash flow. And this cash flow in that particular model, if we do 70-30, it means 70% of that cash flow will go to investors, the limited partners, and 30% will go to general partners, right? Or the sponsors or managers. They have so many different names. So an extra layer to this, and that's the case in this example, there's a preferred return. So preferred return is the amount of money that will be paid first to investors, and then the split comes after that. So if the cash flow is very, above 8%, which is unseen these days, but if it's above, anything above the 8%, it will be split between the investors and the general partners. But the first 8% they would go to the investors. So that's one additional scenario. So you have the very simple would be just a split. Another level of complexity is a pref then split. And then you can be very creative because you can combine. You can do class A is just a split and class B is just a pref, right? So that's where the classes come around. And in addition, like the fourth layer to that is the hurdles, where you have a moving target on the splits when you achieve some goals, return goals on the deal. Hopefully that clarified.
Thank you.
So going back to the exit strategy here, I was talking about the cap rate at exit that you want to mention in that business plan. And also, I think it's always if pertinent, you want to know who's the target buyer. Is it maybe a smaller deal is going to be somebody like who has with high net worth individual wants to own real estate, right? Or is this going to be an institution who is going to buy it? Institution, they don't need necessarily like high returns, right? And maybe they have like just money to deploy, like if it's a large fund. Return projections. So, I think that's very important for the investors. Like if they invest $100,000, what does it mean for them? So in that particular example, I know there are a lot of numbers, but the bottom line is, year one, they will, we plan the projection is a $3,890 return, right? Year two, you have 9,900. Then there's a refi in that particular example, and we are giving back $94,000 on a $100,000 invested. So basically, at year three in that particular deal, you have more than all your money back, and then you're free flowing. You have infinite returns technically on or almost infinite returns because you have so little in the deal at that point. And you have like all the different metrics such as cash on cash return, the internal rate of return, and the average annual rate of return. Interestingly enough, kind of a unique situation here. You have all these numbers that are very similar. This is very unusual example.
Hey,
So
Philippe,
next,
one more thing. I'm sorry. Just can you hit on the infinite return, because when that might be a new term for some investors, and so I think helping them understand, hey, you put your money in the deal. When your money is returned back to you at some point in time in the deal, anything on top of that is gravy, as we call it, and that becomes an infinite return. But do you want to expand on that a little bit more?
Yeah, because so again here, like year one. I mean, if you just add and let me move my mouse here. You add the $9,000 plus 94, so it means all the money that you invested year one, you have collected more than that at year three after the refi, right? So your net money in the deal at that point, if you look all the cash flow that came back to you're at zero. You're already in positive. You're above. You're invested 100,000. You have collected more than 100,000. So technically, any returns that you make after that date, you can consider it as an infinite return, because the typically the return is, if we take the example of the first year, $3,800 divided by 100,000, it creates a cash on cash return percentage number of 3.9%. But if you divide year 4, $8,700 by 0, it becomes infinite. You know, it's because you don't have any money in the deal at that point.
Thank you.
I guess you should have said 15 here, but the acquisition schedule is what's the timeline until closing, right? What's your closing date? What's where when the paperwork will be available, the private placement memorandum, and when are you going to open the deal for investors to invest? So here again an example. The investment packet, which means the private investment memorandum, it will be available the following week, after that presentation that was made. And the minimum investment is 75,000, and we expected at that point a wire to be wire the money before December 15th. I think the closing was expected or took place at the end of the year. And see here an example as well, and that's typically how it's done, first come, first serve basis, right? So we're going to say, okay, well, we're going to open the investment next week, first come, first serve, and then it could be a waiting list or something like that. To explain a little bit the logistics to the investors. And actually, yeah, I should have added something else, like maybe, you should go to this website, this portal, sign up, you'll be able to sign the paperwork and that kind of things, more about the logistics there. Post-acquisition schedule. So, what can investors expect after they invested? How frequently are they going to get reports? What KPIs, key performance indicators, will they receive? Occupancy, income, expenses, etc. Maybe you're going to send them financial reports. It's recommended. And what's your distribution schedule? So in the example, there will be a monthly report. It's very typical to have monthly reports. You'll tell the investors how the deal is doing. Quarterly distributions, very common as well. Usually not starting right away. It will. You usually have to be patient, wait for 6, 9 or 12 months. For everything to start, especially if there's a transition with a new property manager, and how often there could be additional communication. Could be a quarterly meeting or things of that nature, but usually the very, very typical communication would be a monthly report. So we're getting towards the end there. So how are you going to write, this document? Well, it's like throughout working on the deal, you're going to be able to gather information from different sources. It could be the broker, in the offering memorandum from the real estate broker. There will be good information. The lender, they will run some inspections and underwriting report and appraisal. You have all these resources like big documents and reports that will be sent to you by the lender. A very important property. Resource is your property manager. They are the ones who know the best the market. What kind of rents they can get and so on. And that's why I like to put the property manager forward in our presentations. They are the property manager is the one that will be that will make or break the deal usually. And also your inspection report. Financial projections, you will do underwriting to make the illustrations that I showed earlier for the profit and loss pro forma, as well as the investor returns. you know, all these points that I mentioned, you know, no worry to mention all of them. You know, you don't have to be exhaustive. You know, you just have to pick what makes sense for the particular deal that you're going to talk about. And you know, in terms of format, there, you know, you want a slide deck like a PowerPoint, or it could be. I know, you know, I think my first deal we just did a simple document initially. It was like a Word document in PDF, but you want to talk about all these topics, right? And you know, if you do a webinar about the deal, you want to show, you know, as many pictures and charts as possible to make you know, the presentation visual, which is not the case of this particular slide. When do you write the business plan? You know, as I just mentioned, you're going to start preparing the business plan when you first start analyzing the deal. You know, start taking notes on all these topics that eventually you'll put together in a presentation. And you will finalize the business plan when you get ready, basically to raise for the deal, and it will be towards the end of due diligence. So takeaways. You know, it's a rich document. You know, a lot of things. I think I certainly went over what I expected in terms of time there. But yeah, you know, 16 main topics. A lot of things. Try to make it as easy, as readable as possible for investors. And you know, it is a powerful tool. It will be part. You know, it will be called business plan in your PPM document, and it's a key to a successful deal. So my last slide is just, you know, to give you a thank you, and we can open for Q&A. But before we do, we wanted to mention 2 free resources we have. 5 ways to boost your capital beyond your retirement account at www.boostmycapital.com/guide. And another guide, the accredited guide. Are you an accredited investor? At boostmycapital.com/accredited guide. And you can reach out to me at Philippe@boostmycapital.com.
Great, Philippe. That's awesome. And I had a quick question for you on this present for the slides. Will you be are you okay with having them sent out to the people
Absolutely.
that joined?
Absolutely. Yeah,
Great.
yeah, of course. I will send you a PDF after we're done here.
Great. That's perfect. So before we break, I actually just want you know, one of the things I wanted to do is just to allow folks to go ahead and to ask questions, and then I'll go ahead and wrap us up once the Q&A is over. So please, if you have questions, take yourself off of mute, ask your questions, and then we will we'll go with some final questions that I have at the end. Frank, go ahead, take yourself off of mute.
Thank you. So this business plan, when you create one, is this the one you use when raising capital from potential investors?
Yes. Yes. It's and that's why it's interesting, because it serves multiple purposes. And you know, and it occurred to me, and I realized that when I saw that document I mentioned before, like the PPM, you know, that the lawyer prepare, and you know, they have a chapter in the documents like business plan, and usually they just insert that presentation. So it serves 2 purposes, which is, you know, like, be really your business plan from a legal standpoint in the PPM, but also is the presentation for investors.
Good question. Anyone else have questions for Philippe? If you don't want to take yourself off of mute, you can post them in the chat and I can read them. All right, well, I will go ahead and ask a couple of closing questions for you, Philippe. So again, thank you very much for the awesome presentation. I think that presentation is great for both active investors or those looking to get into doing what you do, as well as those who are passive investors as well, interested in understanding the inner workings of how deals are put together, how information is communicated, and what are the important things that passive investors should be looking at. So thank you very much for hitting on those things. So I just had a couple of questions for you before we wrap up that I'd like to ask all of the speakers that come on to the Wealth Mindset and Real Estate Investing Meetup. And the first question that I have is really about, what does financial freedom mean to you? We hear that talked about a lot, and especially as you enter in to the real estate investing space, and people talk about it, but I recognize that not everyone understand what that means, or at least they may have a different meaning. Can you talk a little bit about what it means to you?
Yes, sure. It's an interesting question because I have a lot of students, and you being one of them, Chris, and like when students come into the program to learn about multifamily syndications, they come with different attitudes, and a lot of them, they come and they talk about this financial freedom. And I think it's certainly a very good goal, but embracing the career of multifamily syndications and being, in the role of a general partner and a sponsor, you have a lot of responsibilities. So, doesn't mean financial freedom doesn't mean necessarily not working. So, the way I define financial freedom is because it is that you can choose to work because you want to, right? And you have enough passive income and other businesses generating money for you. But if you want to work, and because you like it, and it's my case, I like to keep active, and looking at deals and working on developing my company, etc., and making sure that our investments are working well. So and if you can choose to work because you want to, I think that's financial freedom.
Great. No, great answer, great perspective. And I think it's something really important to recognize. That choice is a really important one. So but before I jump to the next one, I see there's another question that Frank has. Please go ahead, Frank.
All right, thank you. Oh, so back on the splits, like 70-30 or 80-20. Oh, you said something like moving the goalpost. Let's say if you achieve a certain returns, maybe those splits can go maybe 60-40 or 50-50, right?
Correct.
Oh,
Correct.
do you mind maybe a couple of seconds just explaining it a little bit more? If it's just too complicated, it needs too much time to explain, never mind. I don't want to waste everyone's time. But
So moving like with the changing the split when you achieve a goal.
that's correct. Because it's my first time hearing about that. So I was kind of curious. Oh, that sounds like a good idea, but how does it work?
Well, so from I mean, so it's going to be like an underwriting exercise, really, and you're going to and let's say you a very very simple example is you underwrite the deal, and your goal, and which is a very, I would say, kind of typical type of returns that you can see in the industry, is you're going to say to the investors, you're going to double your money in 5 years, right? And so that's your baseline. And you can say, okay, well, the parameters to achieve this baseline is the split is 80-20. 20% for the general partners, 80% for the investors, or limited partners. So what you can say is, look, and I think obviously at that point it's already like a very good return. It's for investors it's pretty good, but as an extra incentive for the general partners to work extra hard and make sure that the deal is doing well, you can say and define, say, if we go above doubling the money of the investors, any money that would be beyond that, so beyond what we plan, instead of doing 80-20, then you do it 50-50. And really, like, to explain further than that, I would have to go through an Excel exercise to show you more specifically. Hopefully it clarified that question. But that's it's called a hurdle. It's not everybody do that, and I know it's a little bit complicated sometimes, but that's the easiest way to talk about, to explain that. Like, you have a baseline with the normal splits, and if you go beyond that baseline that you're presenting, the splits are going to change.
Awesome, that cleared my question. Thank you so much.
Thank you.
You're welcome.
Bibi has a question. I hope I'm pronouncing your name correctly.
Yeah, hi everyone. I want to know how we can communicate to investors that we would like to buy them out, because I know if you tell them at the beginning that after we've returned back your returns, I'm giving you back your returns which we agreed to, and we're going to buy you out. Some of them might not even want to join you. So how do we communicate that to them, that after so period of time, we've given you the returns we promised you, you've made money and all that, we'd like to buy you out?
Yeah, so that would be and obviously, I think that would be a very important topic to address in the presentation, because it's rather, at least in my experience, not very, very common. I heard some examples, but it's not the norm. It's more like an exception. So it's certainly something you want to make clear to investors, and in addition, so make it clear in the presentation that you make to them, but also it will be explained by the lawyer in the private placement memorandum, and probably the operating agreement of the LLC. So it will be written and explain the terms of how when you hit those returns and so on, they will lose their ownership share. But again, that's pretty. It's you can do you can do very a lot of you can be very creative on the structure. After, it's just a matter of making sure that everybody's on the same page. That if I understood correctly, that after meeting some level of returns, now they don't have any ownership. So which in other words, it would correspond to a hurdle with a different split, where it would go 100% to general partners, 0% to investors. Something to think about too. Yeah.
Okay.
You're welcome.
Thank you.
Good question. Frank has another question. Go ahead, Frank.
Oh, it's not a question, but I just wanted to comment on what she asked. for somebody like who is new like us or having something like that, it could kick out some investors because they'll be like, okay, so you just want to use me for my money and kick me out of the deal. They wouldn't be interested to invest in my second deal or third deal or something like that
So
because they won't have any ownership. You just use them for their money and they disappear.
and you know, actually, absolutely, if it's presented that way, it could be less attractive for them. But the other way to do that is to present it as debt, and you can say, look, you know, I'm going to give you 9%, you know, whatever, on this deal during 5 years, and those are the terms. You know, it's like I commit to giving you that money, which, you know, you shouldn't commit. But there's a way to structure this, and if you structure it as debt, or let's call it pseudo debt, because sometimes the lender, they don't like the debt, but there's a way to structure that, and still make it appealing to investors.
Good point. So, well, I thank you guys for the engagement, for the great questions. I'll wrap up with the final couple of questions here, and then we'll let everyone break, because I recognize that we're just over time, but I think it's important that we hear what Philippe had to say about these last couple of questions. So, Philippe, another question for you is for me. I love to travel with my family, especially, and I know you do too. What is one of the best trips that you've taken, and why was that one of the best trips that you've taken?
Well, one of the best trips is when I met my wife. I traveled to Japan 2 times, several years ago, and it was a very interesting experience for me, because I didn't know Asia. You know, had never visited, and you know, it felt a little bit like the movie Lost in Translation. But you know, why it was such a great trip is because, you know, I had had the opportunity to meet my future wife at the time, and you know, we had the opportunity to develop that relationship and bond together, and that's why it's a very important part of my life, really.
That's awesome. That's really great story. Um, the next question that I had is, you know, a little bit about, you know, you talked throughout the presentation about some examples of maybe some things that you had in the past, or things that you might be working on today. Just kind of passed over and using it as examples throughout the presentation, but that kind of piqued my interest around, you know, what are you working on these days? What are some of the things that you're doing in your area where you live down in Georgia, and then you know, other types of things that you're working on these days with your company Boost.
Yeah. So we have, I mentioned during the presentation, we have an investment opportunity in a portfolio of 3 assets in 3 different markets with 3 different business plans. It represents 650 units or so. And we're very proud about that opportunity, because it offers so much diversity, and I think, you know, we're putting the odds of success on our side, and so that's one opportunity. Actually, we just received a few days ago of our first distribution. Or, I mean, we made our first distribution, and so that was an exciting time, and you know, we still have a little bit of room there if people were interested. And the other thing, topic that takes a lot of my time these days, we are launching I'm a co-host of a face-to-face meetup here in Georgia, in Atlanta, and our first event will take place next Tuesday.
That's awesome. So for anyone that is live here today that is down in the area in the ATL as they call it, make sure you find Philippe's meetup. Philippe, what's the name of the meetup?
So the group is the Atlanta Commercial Real Estate Network, or acronym is ACREN, ACREN. Though I think you have to, for the time being, you have to spell the whole thing to find it. We're kind of ramping up.
Ramping up branding, no problem yet. So I know that there are others that were not able to join this evening that do live down in the Atlanta metro area. So we'll make sure that when we circulate the slides and your contact information, we'll include a link to your meetup as well, so that people can find you and
Absolutely.
meet you in person for those who live down in that area, which is the beauty of having a virtual meetup. But there's nothing that replaces that face-to-face interaction. So I know your meetup is going to be awesome. So congrats on that and on the
Thank you.
fun that you have with Boost Capital Group. So final question is about the name of this meetup is called Wealth Mindset in Real Estate Investing. What does having a wealth mindset mean to you?
Well, it's interesting you ask me that question, because I'm reading or listening to the audiobook The Millionaire Next Door, and a book that I recommend. Actually, I'm listening to the follow-up, which for people who don't know, it's the initial book, and it's follow-up. It's based on a study of number of millionaires in America, and their characteristics and so on. And they make a very, very strong difference between wealth and income. You can have a lot of income, but if you spend everything, you don't necessarily have wealth. And so I think wealth is wealth is, I think it's the ability that you have to really put money on the side and make that money work for you. That's how, and make it grow with compound interest. That's the wealth mindset is pay yourself first to and put your money at work, and make it grow like that. That's how yeah. That's the worst mindset, in my opinion.
That's awesome. Thank you so much for that and for all of the content that you provided tonight. This was really terrific. I'm gonna say thank you to you again, Philippe, for your time and your passion and commitment to providing the great content tonight. Thank you for all of those who joined us this evening, and for those of you who weren't able to join, we will have the recording. We will have Philippe's contact information, other materials for his meetup in person down in Atlanta, and we will circulate that out to the entire membership of this meetup, as well as of course all the people who are here today. We'll have that, and that should come over the weekend. So thank you guys again. I appreciate it, and everyone, you can have a good night. I'm going to stop the recording and allow everyone to get on